Hello, welcome back. Here is Ali Talabi, and this is Module 17, Payout Policy. As a shareholder, you probably expect to receive some dividends from the company that you invested on. In this module, we are going to talk about the payout policy, the dividend payment, the cash dividend, the stock dividend, the stock repurchase, a stock split, and you will see the differences and the impact on the financial statement of the companies and on the stock price of the company. And the next lesson, we'll talk more about the signaling and the information content of dividend payment, what will happen when a company is paying actually the dividend. And then we'll talk more about the theoretical perspective, and we'll talk about the three different approaches to dividend payment and the implication and consequences of the dividend payment on the market value of the firm. And finally, we'll wrap up. We'll talk about the tax treatment of dividends and capital gains, both in the US and Canada. So let's start our first lesson. So when we talk about the dividend payment, what does it mean? For sure, mainly we're talking about the cash dividend, which means the payment of cash by a firm to its shareholders. However, remember, usually we have two general forms of cash dividends. Either we're talking about the regular cash dividends or the extra, or it's also called a special type of dividends. The regular cash dividends are those type of dividends which are generally paid on quarterly basis and expected to be maintained in the future. However, when we talk about extra or special dividends, we're talking about one-time dividends, and you don't expect there will be repeated. So just one-time dividend payment. So the major focus whenever we talk about the cash dividend, it's actually on those regular cash payments which you can expect to receive on quarterly basis. What is the procedure when it comes to dividend payment? So usually there are 5 stages which are involved when it comes to dividend payment. The first is the declaration date. For example, let's assume a company is declaring that it's going to pay dividends for the specific amount at a specific time to its shareholders. So when the company states or declare the dividend payment, that's now a commitment for the firm to fulfill that responsibility. Before that, as you know, when we talk about the common shareholders, the dividend payment for the company is not mandatory. However, when they declare, now that becomes mandatory for the company to pay. Then, after a few months, we're talking about the with dividend date, also called as com dividend date. What is that with dividend or com dividend date? It means that if you hold the shares of the company on that date, for example, our example is October 25th, you will be eligible to receive dividend. The day after, it is considered as ex-dividend date. So if you, for example, buy dividends of a company, a stock of the companies on October 26, you won't be eligible to receive dividends from that company. And record date, which might happen 1 to 3 business days after the ex-dividend date, it's actually the time that the company is collecting information regarding eligible investors who are eligible to receive the dividends. And finally, there will be payment date, which might happen the next months, following months, and the company is starting to pay dividends to shareholders. So they will receive actually the cash dividend from the company. That's the kind of the final stage of this dividend payment process. So remember, there is a major difference between the with dividend date and ex-dividend date. And if you notice in the stock market, actually, so if you look at the stock market, you see, for example, the stock price, let's assume is $30 on October 25th, and the company is paying $2 dividend. So you expect on October 26th, the stock price is dropping by the same dividend amount, which is $2. I'm assuming there is no other information, there is no other type of event. So rationally, that's the stock price changes. So that's a big difference between with dividend and ex-dividend date. And remember, you won't be eligible to receive dividend if you purchase stocks on October 26th in this example, which is the ex-dividend date. Paying cash dividends is not only way the companies actually can pay cash to its shareholders. There are some alternatives to the cash dividend. For example, the company can go with a stock dividend. So instead of paying cash to its shareholders, actually what company is doing, the company is actually distributing additional shares instead of cash to the firm's shareholders. And for sure, the consequence on the stock price and the market value and the financial statements items will be different. We'll talk about that in a next few slides. A stock repurchase, that's another way the company is actually going to buy back its own shares. In this case, the company is paying cash, but in exchange, it's collecting cash from the collecting the stocks from the market. So the company is buying back its own shares. And remember, this is sending a positive signal for the market. So if a company is buying back its own shares, remember that's a positive signal for the market because it sends a signal that the company believes that its stock is undervalued, so it is confident about the future growth and the future earnings of the company. We'll talk more about signaling later, but remember, whatever decision the company is making regarding the payout policy, it impacts on the information content of the market, and for sure the stock price will be affected. So when we talk about the stock dividend, maybe it's better to go with an example to explain what actually is happening. So let's assume a company has currently 4 million outstanding shares at the market price, $20. The company declares 50% stock dividend. It means the company is going to issue additional 50% shares, which means another 2 million shares will be added to current 4 million outstanding shares. The question is how many shares will be outstanding after dividend, and also after stock dividend, what will be the new price per share for this specific stock, and for sure total value of the firm. So as I mentioned, what will happen, the additional shares will be 50% of 4 million, which is 2 million shares. The company already had 4 million, so it means the total shares will be 6 million. What was the old value of the stocks? The total market value of the stock was 4 million times $20, which is $80 million. Remember, the stock dividend actually doesn't impact on the total value of the firm. No impact. Yes, for sure, the stock dividend will increase the number of shares, as you can see, but no impact on the total market value. So the only thing here is happening is a reduction in the stock price. So since the number of outstanding shares is going up, you should expect lower stock price. So 80 million, the same market value. Now this time divided by 6 million shares, it will give you $13.30. So the stock price will go down. The total market value will be still the same. The number of shares will increase. And remember, as an investor of the company, your total wealth won't change. You have now more number of shares, which each worth less. Again, I'm ignoring here the signaling effect, how the market is reacting. We're just talking about the changes on the paper actually. So in some cases, maybe companies that decide to go with a stock split or reverse split. What do we mean by a stock split? It means that the company is increasing actually the number of outstanding shares by issuing more shares to current shareholders. For example, if the company goes with 2-to-1 stock split, it means for each share that you have, you will receive another share. So which means that the number of shares will be doubled in this case. What is the incentive here? The incentive here is to keep the share price in an acceptable trading range. For example, if the stock price is like $2,000, $3,000, the liquidity will be a little bit less because it's kind of more expensive to buy shares of the company. So what the company is doing with going the stock split, the share price will go down. However, at the same time, the number of outstanding shares will go up. In some cases, maybe the companies go with the reverse split, which means they reduce the number of outstanding shares by exchanging less new shares with the old ones, which means the number of outstanding shares will go down, which means the stock price now will go up. The total market value should be same, but again, remember here, I'm ignoring the signaling effect. So the market might react differently and there might be some impact on the stock prices. So let's talk about the financial impact of all these different policies may companies follow. So here I'm summarizing what we discussed regarding a stock split, cash dividend, a stock dividend, and stock repurchase in a table. So what's the impact of a stock split on number of shares? As we discussed, the number of shares will go up. So plus in this case, it means it's going up. Minus, it means it's going down. NA, it means there is no specific impact on that specific factor. So the return earnings is not affected. The stock price will go down. The total market value for the stock split won't change. What about the cash dividend? So when the company is paying the cash dividend, for sure, no impact on the number of shares. However, the return is going down. The company is paying from its return earnings to shareholders. So you expect the return earnings going down, and the stock price also will be affected, or it's going down, because actually the total market value of the firm is going down. When the company is paying cash, that's the impact. The total value of the company is going down. How it is kind of reflected in lower stock price. When it comes to a stock dividend, we just mentioned the number of shares will go up because the company is actually paying a stock instead of paying cash or giving more stocks to current shareholders. The return is going down because actually what you're doing here, you are taking out the dividends. You're taking out dividends from the return earnings. So you expect the return earnings is going down. What's the impact on the stock price? You should expect lower stock price. However, the total market value should be same. Why? Because at the same time, the number of shares is going up and the stock price is going down. And remember, the market value is based on the number of shares times a stock price. So if one is going up, the other is going down with the same ratio or proportion, you should expect no impact on the stock dividend. A stock repurchase, number of shares is going down. The company is buying back its own shares. We assume the return is going down. As I mentioned here, remember, we are assuming the company is buying back its own shares at a higher price than the book value. And usually that's the case. The company is paying more than the book value. If that's the case, the returns should go down. The stock price will go up. And finally, we are assuming here the market value will not be affected. Again, the assumption here is as the number of shares are going down, the stock price is going up with the same ratio. So that's the total financial impact on these four different events. That's it for today. Thank you very much. Talk to you soon more regarding the payout policy in the second lesson. Since then, have a wonderful day. Talk to you soon. Here is Ali Talabi.